Well, with us is Harrison Johnson, CFP. Harrison, thanks for being here today.
Always.
We got a topic here that is, when you first look at it, like, what 50-year mortgage, helpful or hurtful? That's a long time to pay. What do you got? What are you talking about here?
So this is something that's been in the news a little bit recently, and I thought it'd be kind of fun to talk about. We have 30-year mortgages, 20-year, 15-year, 10-year. So these are these mortgage terms, and the longer you have a loan, the lower the monthly payment is. So there's some people thinking, well, maybe if we just offer a 50-year mortgage, then that'll bring payments down a little bit and people can have a little bit easier time affording houses. Now, some of the critics that argue against this say that, well, if you have a 50-year mortgage, that means you're going to pay a lot more interest to the bank over that time. And right now, the average age of the median age of a first-time home buyer, I think, just hit 40. So if you're 40 and then you get a 50-year mortgage, you'll be 90 by the time it's paid off. So people are saying, you'll never be paying this off. You'll be paying it off for the rest of your life. And while those two arguments, paying a lot of interest and it's way too long, they might be on the right side of this conversation. Those two arguments I don't think are good arguments because how much interest you paid to a bank over time, I think, is irrelevant. The interest rate is what matters. Because if you can get a low interest rate, I don't care how much I'm paying to a bank because I would rather invest money in something else that's going to earn more. Just like people right now that have 30-year mortgages locked in at 2%, yeah, they could save interest by paying it down faster, but they shouldn't do that because there's other things that invest in that make more than 2%. And then the other thing is, with the time of this, a mortgage lasting 50 years, most mortgages today don't last the whole term. They don't go to maturity because the house is sold or the mortgage is refinanced or people pay it down quicker. So those are not good arguments. And a 50-year mortgage, at that point, it's really not that different from an interest-only loan. Like HELOCs, for example, are interest-only loans. So this monthly payment is a little bit smaller. It gives you more flexibility. So if this were to be something that gets rolled out, smart people could potentially use this to have a lower payment and then invest in more in other places. However, I think in practice, most people wouldn't do that. So most people, if this came into fruition, would use these mortgages and they wouldn't be saving money in other places. And so they would then not have as much wealth accumulation because they're paying these loans down slower while not accumulating assets. So overall, I think this probably would not be a good idea, but that doesn't mean that it can't be used well. I think just most people wouldn't use it as efficiently as it could be.
I think it's like a very sharp knife. You can do a lot of things with a sharp knife,
Yes.
but you can cut yourself and hurt yourself
Yes,
as well.
yes.
And this is where, again, a good financial planner can help you because I like the idea that you're going to pay less per month. Yeah, 50 years is a long time. But if you're wise and you now say, take that difference and you say, well, now I can max out my 401k, I'll have a great retirement. It used to be you want to pay your house off when you retire, you don't have that. But if you do the opposite and you have a great 401k and at retirement, you've got $1 million, $2 million that's going to provide great income, you don't care that you got that payment. You're going to have to pay it anyways. And I believe it's probably changing now because such low mortgages. I believe that the average holding for a mortgage was about 7 years.
Yeah, last I looked into it, it's about 7 years, which again, the lowest term mortgage, I don't think there's 5-year mortgages out there. I think the lowest you can get is a 10. So even those don't go to fruition. Okay. So 50 years, whether it's 30, 50, whatever, they're not going that long. And a mortgage that lasts 50 years, for example, all that means is you can pay it off as quickly as you want to or as slowly as you want to, up to a maximum of 50 years. If you want to pay it off in 30, you just have to pay a little bit more. Yeah. But if you can get a low interest rate, interest rates have been coming down. If you can get a low interest rate, there's no reason why you can't use this as a good tool. Like you're saying, Brent, you can use a knife to cut things or you can cut yourself. If you use it as a tool correctly, it can be helpful. But a lot of people don't do the right things with their finances.
That's why they need a financial planner that knows what he's talking about.
I was going to say 2 thoughts on kind of differing sides of the aisle here. Is the first one is obviously you talk about a lower payment, and unfortunately, I think too often people will look at the lower payment like it's a lower payment, that's great. But again, if the interest rate's higher, substantially higher, then it's not great. Like I see a lot of times now with like a firm and these buy now, pay later things. It's great if you can get the 0% interest, and I highly recommend using it if you can get the 0% interest. But other times you see in there, it's like, oh, I can spread it out over 24 months, but the interest rate's like 14%. don't do that.
right.
You know, so if the 50-year mortgage comes out, I'm just gonna say the 30-year fixed is, let's just make it easy, 5%. If the 50-year fixed is 7%, it's like, ugh, that might not make sense. That's again where you have to break down the numbers to see what makes the most sense. Now, kind of the other side of the coin, as Harrison already brought up, doesn't know if he thinks it's a great idea because, you know, people won't use them properly. And this is kind of where this whole concept, and I hate this term, but it is so true, forced savings. People are their own worst enemy.
Yeah.
And that is one thing I'm going to say that's beneficial about real estate is it does force people to actually build equity in something, and they do it without even realizing it. And doing this 50-year mortgage, again, the wrong person that doesn't understand things, they could be all of a sudden 70 years old, 30 years into the 50-year mortgage, and they have no assets. And then they're forced to sell the home because they still owe a ton on it, and it could be detrimental. We've seen people before where they retire with nothing but their home, and it's an asset that, you know, if you can't afford the taxes, the insurance, and now a mortgage for another 20 years, you could be out of luck. So, I mean, that's where, again, coming up with a good plan and utilizing these properly is beneficial. But if you don't, it could be terrible.
Yeah. And I mean, with mortgages, like Brent, you have an interest-only payment on your mortgage. So it can be used correctly. That means you're paying no principal.
Yeah.
So you're paying that into infinity.
Yeah. And I'm fine with that because what we talked about is that I invest my other money.
Right.
I do fine. And I know that house will appreciate. And again, I'm only expecting, I've said this before, if in 10 years my house is up 50%, I'll be thrilled. But I didn't have to spend more for it. In the meantime, my investments grew much greater than that. So I can provide income, and I'm not going to retire, but if I want to retire, I can provide income to pay that mortgage. And that's what, but you got to be disciplined. If you're not disciplined, as Chase, you said, there's going to be people out there, they're going to think they're going to do it, and they don't, and then they really hit retirement. They got no other assets, and they got to sell the homes. They can't make payments.
The other thing I'll say on this is the whole point of this even being talked about is trying to make housing more affordable. Well, having a 50-year mortgage as an option is not going to bring house prices down. If anything, they'll stay the same or even go up a little bit. So in that regard, to me, it doesn't seem like it's addressing the root cause of unaffordability. If it's used correctly, it could be helpful, but I think unfortunately a lot of people wouldn't use it correctly, and then they'll complain about
Blame
it.
the government.
And I'll put you on the spot here. You probably didn't do it, but if you had somebody come in and asking about it, you probably do a comparison what your payment is for a 30-year mortgage versus a 50-year mortgage and how much you're actually saving during the 50-year. I don't think it's going to be like half.
It's not. I mean, it's depending on the size of the loan and the interest rate. It's a couple $100 a month potentially. Yeah. So it's not groundbreaking, but I mean, an extra couple $100 is an extra couple $100. And really, if you can save an extra couple $100 into your 401k or into an investment account over 50 years, that'd be a lot. So.
Yeah, and I like the interest-only loan, obviously, because it's just I'm paying the interest. But again, I can invest the money other places and do better than I would paying off a 5 or 6% loan.
Yeah, absolutely.
So, yeah. Well, Harrison, thank you very much. We appreciate it. Great information. And do people know if they should get a 50-year or not?
Well, right now it's not possible. They do have.
We're talking about it.
They do have 40-year mortgages out there, and for jumbo size loans, they actually look pretty attractive, I think.
And it's not a one fits all. It depends on the situation.
Depends on the situation. Yeah, right. Absolutely.
Here's your number real quick.
Yeah.
Using the median sale price of $415,200, the current interest rate of about 6.3%, a 30-year fixed loan with a 20% down payment, monthly payment of just principal and interest would be $2,056. If you raise the length to 50 years using that same interest rate, which again wouldn't be the exact case, the payment would be $1,823, a savings of $233 per month.
Yeah.
So I mean, it does add
10%,
up, but yeah.
That's only on a $415,000 purchase price.
Yeah,
so
and that's 20% down, so it's 80% of that.
No, there's a lot of $450,000 homes in San Diego, right?
Yeah.
Harrison, thank you very much. Appreciate it.
Thanks, guys.
Again, that's Harrison Johnson. He is our financial planner. He is a CFP. If you want a free consultation with him, give him a call on the phone, 858-224-0004. Again, that's 858-224-0004. Again, set that free consultation here in the office. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Send an email, and he'll get back to you and set that free consultation with him.